Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're talking Multifamily 2017. My guest is Jay Parsons. He's VP of MPF Research, part of RealPage. And Jay, you have an announcement for us, don't you?
Yeah, we had some good news in the past week or so. Our parent company, RealPage, announced the acquisition of Axiometrics, which, as you know, is one of the leading apartment trackers in the country. So we're real excited to bring them into the RealPage family, along with MPF Research and our partnership that we have with Real Capital Analytics. So it's very exciting.
That's fantastic. Congratulations. And so, Jay, talk to us about cap rates for 2017 and moving forward for the multifamily world, because I think we're all curious about your crystal ball and how it looks, because I guess we're expecting rental rates to climb a little bit. We're thinking about, hey, there is some new supply coming on the market in some of these markets. And then also, we have the rising interest rates. So what do you see?
Well, let me preface any comment by saying that I think anyone who's tried to forecast cap rates has been proven wrong in the last 5 years. So it's kind of a fool's errand. But my best guess is that we're going to see cap rates remain around where they are today, in the mid-fives range. We've already seen some stagnancy in rates for the top tier, Class A, core markets and urban properties. We really right around 5%-ish, and in some cases less than that. But you don't see a lot of compression at that segment. And so what's driven compression on a macro basis for apartments is the, garden and tertiary. And, that's been coming down for the last couple of years. And so I would be surprised if we saw further compression in that space. So I think we're going to be settling right around where we are.
Okay. And Jay, I'd like to ask you about your expectations for 2017 related to a Trump presidency. Obviously, he's trying to do a lot. He has a big agenda, and one of those is to potentially reduce corporate tax rates and personal tax rates. So if he's able to do that, and what do you think he might be able to do it? Does that mean tenants have more money to spend on rent? Does that mean corporations are going to create more jobs and therefore the multifamily industry benefit?
Yeah, I mean, that's the big question everybody's talking about, and we just had the big NMHC annual meeting last week in San Diego, and that's a question that's been a hot topic right now. And I think that it's hard to take any one of these policies in isolation because there's a lot that's going on. I mean, obviously, you can make a strong case that lower tax rates and some of these other business-friendly policies, deregulation could be a stimulus for job growth and housing demand. On the flip side, there's some nervousness about the protectionism views toward trade and the impact that could have on the economy. And so I think there's some unknowns here. I think you can make a good case that they'll have accelerated job growth, but I also think you can make a plausible case that we have some trouble. So I think that's going to a little bit of to be determined.
Interesting. So what else do you think might impact the apartment market moving forward?
Well, the other hot topic, particularly on the capital side, that everyone was talking about at NMHC and really since the Trump election, has been, what happens on the debt side with, how much Trump could deregulate that space as his team has promised to do. Obviously, as you well know, the risk retention rules put in the prior administration are extremely unpopular among commercial real estate investors and lenders, as well as the so-called high risk or high volatility commercial real estate designation. I think there's good reason to say that some of those designs, maybe well intended, weren't sufficiently thought through, and the impact they'd have on housing. So I think that there's some excitement that we could. There was initially some concern that we'd see some slowing in capital coming into the commercial real estate space, particularly multifamily in 2017 because of those rules. But with lenders now knowing that those things are going away, I think there's a little more willingness to sort of keep the party going a little bit.
Yeah, that's good news. So with the close here, Jay, I know you have to go. Close with a tip for us if we're an investor, we're an owner of multifamily or developer.
Sure. in this cycle, and we continue to hear this at NMHC, we've seen so many investors really targeting the same strategy. And, Michael, you and I have talked about this a little bit before, where there's been so much interest in going urban, going, high-end luxury, and that was clearly an opportunity in the early part of this cycle. But what it does concern me a little bit that we still see so much money attracting that same strategy, 7 years later, given what we're seeing in the fundamentals. And so, if I'm a developer, I'm an investor, and I'm really looking at high-end suburban areas close to jobs, high home prices. These are the areas that have the real barriers to entry these days. I think of areas like Plano outside of Dallas, Alpharetta in Atlanta. I mean, these, it's hard to get into these spots, but the fundamentals there are great. The incomes are fantastic. You're close to jobs and retail, hospitality, high home prices. And so if you can make those deals work, that's where I would be, and certainly for the value-add strategy as well.
Okay. And what about existing owners as far as management? Any tips there, Jay?
Yeah, as I alluded to earlier, I think the key factor for 2017 is let your internal fundamentals guide you. Trust your revenue management. Don't be distracted by the anecdotal stuff that comes through the leasing office about what people are saying. Obviously you need to be aware of those things. But at the end of the day, if you have 4% vacancy and you see a little bit of tick down in retention rates, and occupancy comes down 95%, that's not a reason to panic. And you really need to hold, there's an opportunity, particularly in that B space and in the suburbs, you're not competing with supply, to continue to push on rents. And ultimately, for operators who choose not to, even when fundamentals are still strong, obviously there's always exceptions, but on a macro basis, you're leaving money on the table.
Right. Well, great tips, Jay. Thanks for joining us.
My pleasure. Thanks for having me.
If you like more from Jay Parsons, he is VP of MPF Research at RealPage. And, of course, as you've heard, they just are buying Axiometrics, so really powerful company there. If you want more information, visit mpfresearch.com. And stay with us. We'll have more on Multifamily 2017. I'm Michael Bull. You're watching or listening to The Commercial Real Estate Show. Hey there, thanks for checking out The Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.